India just changed how it measures your cost of living. Not loudly, not dramatically, quietly. The customer price index, the number that decides the interest rates, EMIs, savings returns, and even the government policy, now uses 2024 as its base year instead of 2012. And this is not just a technical update. This is India officially admitting that the country of 2024 is very different from the country of 2012. And when the way inflation is calculated changes, the way your money behaves also changes. Every time the Reserve Bank of India adjusts the repo rate, it is reacting to the inflation. Every time your home loan EMI increases or decreases, it is indirectly reacting to the CPI. Every time you complain that price feels higher but inflation number looks stable, you are questioning the CPI without even knowing it. So when India updates the base year from 2012 to 2024, it is redefining what the normal spending looks like in India. The Consumer Price Index measures the average change in prices of goods and services that people buy. It tracks 358 items across rural and urban India. From rice to mobile recharge, from school fees to transport, everything is included. But here is the most important part. The weight of each item depends on how much Indians actually spend on it. If Indians spend more on something, it gets more importance in the index. If spends less, its importance reduces. In 2012, India was a different country. UPI did not exist. Online shopping was limited. Food made up a very large portion of Indian household spending. Urbanization was lower. Disposable incomes were lower. Fast forward to 2024. Digital payments dominate. OTT subscriptions exist. Online services are normal. Middle class consumption patterns have changed. Urban India has expanded. And even the rural India is more connected than ever before. So measuring today's India using 2012 spending habits would be like using an old photograph to judge the new reality. One of the most significant changes in the new CPI is that the weight of food has reduced sharply. This does not mean food prices are less important emotionally. It means that as income rises, Indians are spending a smaller portion of their income on food compared to the services, healthcare, education, communication, and digital consumption. This reflects economic development. Typically, as countries grow richer, food takes up smaller share of the total spending. India is signaling that it is moving towards that direction. At the same time, services and technology now carry more importance in the CPI basket. Mobile bills, internet services, transport services, healthcare, and education matter more in the new index. This tells a story. India is no longer just an agriculture-driven consumption economy. It is becoming service-led. The digital economy is no longer optional. It is central. And when these categories gain more weight, inflation measurement starts reflecting a more urbanized and modern India. The Reserve Bank of India uses CPI inflation to decide the monetary policy. If inflation rises beyond its comfort range, RBI may increase the repo rates. Higher repo rates means higher home loan EMIs and higher borrowing costs. So, when inflation falls, RBI may cut the rates which can reduce the EMIs. So, if CPI structure changes, the inflation number itself may behave differently. That means policy decisions could also shift based on this updated measurement of reality. If the new CPI shows inflation behaving differently because of the new weights, it could influence how long the interest rates stay high or when they fall. That affects home loans, car loans, business loans, and even the fixed deposit returns. Inflation is not just statistics. It decides how expensive money is. And when the formula changes, outcomes may change too. Now comes the deeper question. Does this new CPI truly represent every Indian? India is diverse. Urban lifestyles are changing rapidly, but food inflation still hits the rural households harder. Some families still spend a major chunk of the income on essentials. So while the revised CPI reflects a transforming economy, it also raises debates about the representation. Inflation feels different depending on where you live and what you earn. This update is more than statistical. It signals the confidence, it signals the structural change, it signals that India sees itself as a more urban, more digital and more service-oriented economy than it was in 2012. The base year shift from 2012 to 2024 is like updating the country's economic mirror. And when a nation changes the mirror, it uses it to see itself. The reflection changes too. So the next time you hear that inflation is 5% or 6%, remember that behind that number there is a new definition of what India spends on. Inflation is not just about rising prices. It's about what we value, what we consume and how we live. If you found this breakdown useful, please subscribe.